Well, thank you everybody for joining us today on another joint webinar. I'm Rich Harvey, CEO of Propertybuyer, and I've got with me Theo Chambers, CEO of Shore Financial, one of Australia's largest mortgage broking groups. So, Theo, great to have you on not the podcast, the webinar today.
Thanks for hosting me. Yeah, we normally do podcasts, so
Well, I
this,
keep looking at your background. I keep thinking we're doing a podcast again. So,
yeah, yeah.
anyway, but
Thanks
very
for
good.
thanks
We
for
have
hosting
a
me and
packed
talking to me.
program to get through today, everybody. So, and I'm sure you'll have lots of Q&A questions. So, as we go through the presentation, if you do have a question that's burning, click on the box that says Q&A at the bottom and just type in your question, and we'll try to get to everybody's questions at the end of the presentation. We are recording this, so we can send you a copy of the recording and all the slides that we'll be presenting. Theo and I have put quite a lot of effort into today coming up with some fresh information and fresh data. So we hope you like it and we'll get a lot of information out of it. And please do reach out if you do need help getting finance and pre-approval through Shore Financial. They're a great broking group. And if you need to find a property, either a home investment or commercial, we'd certainly love to help you with our buyer's agent services. Um, so Theo, I'm just going to share the screen so we can get the slides going. And it's screen number 2. Here we go. Just give me the thumbs up. Theo, you can see that? Yep,
Yep,
great.
all good.
Perfect. Wonderful. So let's get started. Today we'll be going through impact of interest rate cuts on property prices, borrowing power. We'll have a quick look at the national property market. We'll have a look at the global economic outlook, particularly with the crazy man Trump in power and what impact that's having on the world economy. We'll look at housing supply, migration, population growth. We're going to compare share market returns versus property returns. We've got some really good data to show you on that. We'll talk about a strategic idea of debt recycling and also market timing and first home buyer incentives as well as giving you a couple of hotspots to look at. So, as they say, Theo, it's a packed program to look at today. So, Theo, I'm going to throw to you to give us a quick economic update. What happened yesterday and where's inflation heading?
Yeah, so the long expected and the long awaited rate cuts are finally here and in play. We had our second rate cut this year. It was definitely expected. Some were actually expecting potentially more than a 25-point cut yesterday from the RBA. At one point, the ASX RBA rate tracker was actually pricing in a 50-point at like a 90% chance. And that was off the back of that, I guess, the global uncertainty off the back of Trump's tariff war and the trade war. We saw equities crash significantly in April. They've already recovered to pre-Liberation Day, Liberation Day being the day in which Trump announced those tariffs. Some say that Trump, and we're going into maybe conspiracy theories here, but probably worth highlighting. Some say that Trump is fixated on decreasing interest rates because it's in the US government's best interest to decrease rates for their own debt position, which a lot of that government debt's coming to renewal this year. There's 6 trillion of debt coming to renewal in June and 9 trillion in total this year. So by bringing down global interest rates and um, financing costs, it basically decreases the bonds that they'll have to renew. So that what happens in America does really trickle down here. And we've seen now that things have stabilized in the US, we've seen yesterday that obviously the chances of a 50-point cut the last few weeks was somewhat dissipated. I still think there's probably going to be at least one or two more rate cuts to come, especially because the big thing that gave us the green light for the rate cut yesterday was that bottom point right there. We saw the trimmed mean inflation decrease to that 2.9%, which is in the 2 to 3% target, as I'm sure you all know. It's on the news all the time, that target. It's the first time we've seen the trimmed mean inflation be underneath that 3% sort of target since December 2021. So that's a big step in the right direction of where we want to see inflation. Unemployment, I think we can go to next. We'll get some more actually on the US rates, but unemployment's coming up, which is also the crucial bit of data that indicates where rates might go, and that's getting to the level they want as well. Unfortunately, yes, the government does want a slightly higher unemployment because low unemployment can put upward pressure on inflation as well, because it puts upward pressure on wages. Um, I think it's worth highlighting that, well, actually, we'll go into the interest rate cycles with you, Rich, um, on that property price chart. But you can see here we've had a few decreases in rates as aggressive as this in the past, or increases in rates, I should say, followed by decreases. And we'll show on some additional data coming up the flow and effect that has to property prices.
Mm.
So we'll go through the next one.
Sure. We'll go to US cash rate and then we'll go to the ones that I've got. Yeah. Mm.
So it's, like I was saying, it is quite crucial to see what the US Federal Reserve has. And like I mentioned, one part's definitely not a conspiracy theory. Trump is focused on decreasing interest rates to the point he had a public argument with the chairman of the US Fed Reserve, being Jerome Powell. He was very frustrated that he didn't decrease rates off the back of the current economic uncertainty in the US. Rates have started to decrease in the US, as you can see here, but they're still higher than the Australian cash rate. So the RBA won't start feeling pressure from the US until the US cash rate becomes lower than the RBA cash rate or Australia's cash rate. That's just because of the bonds market. If our cash rate is higher than the US cash rate, then that can cause a lot of bonds to be sold off in the US and bonds to be purchased in Australia, which puts upward pressure on our currency, on our dollar, because people are basically buying billions of dollars worth of bonds. So yeah, we are all eyes are on Trump, the madman Trump, as some say, and what's happening next.
What's interesting, I'll just jump in there, Theo, is that the bond market got spooked and got rattled. The fact that the bond rates moved quite recently is a very significant factor, and I
Well,
think
that's actually it's a really good point. Actually, I should cover that. But
that's what made a lot of Trump's advisors capitulate on their bullyish behavior. So, what's your
yeah,
thoughts on that?
that's what made him backflip and announce that 90-day pause on the tariff. So essentially, he didn't mind equities being sold off. In fact, he even tweeted that it's a good time to buy. But as soon as bonds started being sold off, causing concern, or the reason for the bonds being sold off was people were concerned that the US might have some issues paying its debt, the US government, that is. And that has a whole range of flow-on effects that is not good for the US economy. So as soon as that started happening, they had to quickly backflip and make sure investors did see faith in the US government's position and ability to pay its debt. Although since then we saw, I think it was just this week on Monday, that they've actually been derated in terms of their debt ratings. They've gone
It went from like a AAA rating down to AA1, I believe. Is that right?
yeah, which is that was quite concerning. I'm surprised equities didn't react to that. When I say equities, share markets globally, it's the share market in the US didn't seem too fussed about it. And
It's a good point to make that, the fact that Trump is a bit of a bully boy in the way he negotiates, that there are very material consequences in the way that he's acting.
yeah,
And I think if he continues to go and sort of throw caution to the wind, to the world order and the world economy of things, it will actually come back to bite the US.
yeah,
I think this whole idea of Liberation Day is absolutely fanciful. Like we all know tariffs are absolutely stupid policy, and we should have free trade agreements to bolster productivity across the world. But he thinks that by putting up protectionist policies, they're going to instantly create a new manufacturing industry in the US and be self-sustaining. But I think that's absolutely rubbish. So it'll be interesting to see how it plays out with the bond markets. But that does have a material impact on US rates and equities and a whole range of other economic factors.
yeah. Well, we are seeing people actually look at moving their money out of equities because right now shares have both the local ASX and the US share market, they've actually gone back to, like I said, pre-Liberation Day levels, which is a little bit surprising, as in there's this new false sense of confidence, like it's all good, Trump's not going to do all these crazy things, but he's still actually saying there's going to be certain tariffs applied, substantial ones, yet the investors in equities are sort of ignoring that and back to sort of pre-Liberation Day levels. So I do think investors need to be weary on the share markets at the moment because I think things have stabilized to a point which is not justified. We had a podcast last week with one of the division directors of Macquarie who shares that view, especially all this index fund investing. That's the new, I guess, flavor in recent times. I think you just be careful entering now, especially a leveraged index fund,
Mm.
because there's definitely some volatility on the cards. I've already touched on this. Unemployment, it's back at 4.1%. I think the ideal level we want to see it at is 4.5, unfortunately. Um, but it's still, I guess, in range enough to justify rate cuts. We'll keep going. I
And
guess this is the one
forecast.
that everybody loves talking about. I feel like these forecasts have lost their credibility in recent years, though. Uh, all these major bank economists have been telling us that we're going to get rate cuts a year or two ago, some of them.
Mm.
And look, at the end of the day, these economists, and I guess the RBA in itself, they're all just reactive to data. So you're going to watch the data that comes out, the most crucial data being the quarterly inflation data, not the monthly indicator. So yesterday's rate cut was off the back of the last quarter inflation that was released at the end of April. The next likely rate cut will be after the next quarter of inflation, which would be released in late July. And I think there's a meeting in mid-August, an RBA meeting that would be the reaction to that data.
Mm. Yeah.
All in
Interesting.
all, I see, I'm personally, if you're going to ask me for my opinion, I'd say that there's, I can see a cash rate of about 3.1% by December. So still more cuts to come. NAB's a bit more bullish than that, saying 2.85%. But there's definitely another one or two cuts on the cards, that's for sure.
Yeah, I totally back you up on that, Theo. I think there'll be definitely three rate cuts. Definitely one fully priced in for July by the money markets, and then another two after that. So I did predict a 0.35% rate cut this month, but I was wrong. But 0.25 is pretty close. But look, I definitely think there's more rate cuts because the thing about the Reserve Bank and the economists, the Reserve Bank is often a little bit slower to pull the trigger. They are waiting on the data, so they often are reacting on lagging indicators. They're not terribly
Mm,
always proactive unless there's a major economic emergency. So yeah, these economists, we often, throw sticks and stones at them thinking they're hopeless, but at the end of the day, they're just working their things off assumptions.
mm.
All right, let's have a quick look at what this is going to do to both property prices and borrowing power. So I'll talk about the property price impact, and then Theo, you can talk about the borrowing impacts. So a lot of modeling's been done by a lot of very smart economists, and typically what the RBA finds is that for every 1% reduction in interest rates, we tend to get around about a 10% lift in property prices. But you can see here that as property prices as interest rates come down, there's been property prices increasing. So probably a more better chart to look at is the one by the Bank of Queensland here, which shows that after you've had a significant rate cut cycle, what's been the response of property prices. So back in 88, we had a massive 60% increase. Obviously in 2003, we had a 32% increase. Back at the GFC, we had a 15% increase, but most recently during COVID, we had a 27% increase. These are Australia-wide prices. So obviously some cities went higher, some cities went lower. This is an average of all capital cities. So interestingly, this time the Bank of Queensland chief economist Peter Monkton, he expects a 10 to 15% increase in property prices over the next 2 years. What's his name? Christopher Joy, and he's an economist for the Maverick. You often read about him. He's predicting a 10% increase in prices over the next 12 months as well. And again, he's pretty accurate in most of his assessments. So we've got the reason I think we're going to see price increases is simply because we've got a very tight restriction of supply of property. We're not building enough. Construction costs are still high, and we'll get into that more in a minute. So Theo, tell us what's happening. You've got some data here and some analysis. What's happening here in terms of borrowing capacity?
Well, that's probably directly correlated to your comment about the forecast and increased prices in the next 12 months. It's off the back of increased affordability as well, right? Decrease, as you've sort of touched on, decreasing interest rates always puts upward pressure on property prices historically because it's an increased affordability as your serviceability and borrowing capacity improves. So This one sort of summarizes all the movements in interest rates since the start of that increasing rate cycle in May 2022. And we saw the reduction in borrowing capacities peak there at around 42%. So in that last rate rise we saw in November 23, um, the overall impact on people's borrowing capacities was a 42% decrease. So if you
That's unbelievable. That's huge. That's a great figure to point out. That's a massive handbrake, right? Mm.
And what's actually impressive is that even at that peak level, that we still saw price growth, right? So even throughout last year and most of 2023, rates are peaking at triple the level they were to the borrower. That is triple the level they were in the peak of COVID. Yet we saw price growth. Property prices nationally still increase in value.
Mm.
Ironically, where we saw negative growth was back in 2022, purely at the forecast of increasing interest rates. Yet rates were still low. People were borrowing, for an investment, 2.5%, 3%, and that's when we saw negative growth because of sentiment and confidence being affected. That was actually an opportunistic time to buy.
Mm.
Um, so if we look at what's happened this year, like I touched on, we're finally seeing the long-awaited rate cuts already. It's about a 5% increase in your serviceability, the two rate cuts that we've seen. So if you price in another 2 to 3, it's exactly what you're talking about as a property price sort of increase forecast. It's about that 10 to 15%. And that's basically because people, when they go to the open homes and they go to auction homes and they make offers on properties, I can tell you right now, from being on the front line in our business, people are calculating their affordability and their repayments based on current rates. Some are even, there's actually an article that we were quoted in Domain that came out today. Some are even calculating repayments on an additional rate cut or two if they're confident enough that that's coming. So
Mm.
yeah, so we will
Fantastic.
see probably that. Just to conclude this slide, we will see that probably go down to maybe 30% by the year end. So still a 30% decrease of someone's borrowing capacity at record low interest rates back in 2022.
Mm. Excellent. Some really good data there. Thanks, Theo. That's great. Let's turn now just briefly. I'm going to do a quick whip around the country and just look at the national market and where we sit with everything. So we'll start with consumer sentiment. The Westpac Consumer Sentiment Index that's put out monthly is quite an interesting factor because property sentiment and property prices are often driven by sentiment. Just like you pointed out, Theo, people don't always make decisions on the numbers of today, but where they're going to be. So if we feel like we're going to be wealthier, we start spending. Doesn't matter if we are wealthier. But it's been bouncing around that sort of 90 points level, but it's slowly dipped up a bit earlier in the year when we got the first rate cut, and then it slid down again when there was a bit of a drag on the next rate cut. But as more rate cuts come, you'll start to see it ticking up. I don't know if we'll crack 100 this year. We might by the end of the year. Who knows? But it's moving in the right direction.
And you can
Um,
see, just to my point, that where it really dropped off was that 2022.
oh yeah, absolutely. Yeah, phenomenally. Yeah. In terms of auction clearance rates, they're a bit of a bouncing ball. Each of the capital cities has different numbers, but Sydney and Melbourne are the auction capitals. We've been seeing rates around the 60, 65% to maybe 69%. But I can believe that'll start to tick up in toward the 70% as the year progresses. So I expect that during winter, when there's a bit of a short of supply, and then when a lot more buyers enter the market in spring, we'll start to see auction clearance rates really becoming much more healthy in the early 70%. If you look at the 3 month price changes, this is a really interesting figure from CoreLogic. It's now called Cotality. But you can see that we're seeing Sydney, Melbourne, Brisbane all at 1% increases over the last 3 months. So yeah, even Canberra 0.5, Hobart 0.9, Perth 0.7. Interesting, Perth's dropped off a little bit, but all moving in a very positive territory, so nothing going backward. If you look at a 12-month 12-month price increases, Melbourne's still coming out of its sort of decline, but that is soon going to be reversed. Perth has done 10% year to date, Adelaide 9.8, Brisbane 7.8, and Sydney 0.9. But you don't go and buy properties just purely on the basis of historical numbers. You've got to be forward looking and look at the individual dynamics of each capital city before deciding where to put your money. We look at rolling averages. Again, I'll skip that one. Where do current median house and unit prices sit? Look, the core logic numbers are different to Domain. Domain has Sydney sitting at Sydney house prices sitting at 1.675, whereas core logic's got them sitting at 1.47. But still, you can see the relative comparisons between each of the cities. That's the main point of this slide. And the fact that Melbourne is sitting at like almost a 50% discount to Sydney. It's never usually that big a discount. It's normally within about 30%. And Brisbane's got a higher median now than Melbourne. Adelaide's catching up. Perth's certainly catching up fast. Canberra's at 965, Hobart 693, and Darwin 586. So pretty
And
significant numbers there. Mm.
Rich, I just want to just highlight something on this slide, which is also something that there's plenty of articles about. Domain once again did their own piece on this, but that disparity between units and houses
Yep.
in Sydney,
Mm.
that disparity is at all-time highs. You
Yeah.
know, never been such a significant gap between
Mm.
the average house price and the average unit price.
Mm.
And they say that that's a direct consequence of COVID.
Yep.
You know, people were locked up at home and they wanted to get some space. They wanted to get a house. There was a bit of an urban sprawl, you can say, people moving out to more affordable areas for space. But they say that that gap should close because, you know, naturally homeowners and investors chase value.
Mm.
And, you know, if there's value in a three-bedroom apartment versus a two-bedroom house, if one's a lot more appealing purely because of the price difference, then naturally that gap should close. So
Mm.
I think we should, some investors maybe on this webinar probably own units in Sydney and haven't been that happy with the growth and the return as of late.
Mm.
But hopefully hang tight, that should soon correct
It's
itself.
a really good point to be a long-term investor, and don't change your strategy every 2 years or 1 year or 6 months, right? So if you're invested in a unit, absolutely. Sometimes the replacement cost of apartments, what you've got now is unbelievably good. So particularly in Sydney and Melbourne, where to actually build a two-bedroom unit these days can cost 800,000. So the actual land content and land value is almost 100% of the unit value. So don't go and sell them in a hurry is the message. Hang on to them. Sales volumes, yeah, suddenly we're slowly getting back to the 5-year average. So sale volumes have been ticking along pretty well. I'm just going to skip through these pretty quick. I'll skip on days on market. They're sort of tracking pretty well. Listing volumes, yeah, we're still this. The only key point to make here is that listing volumes is still below the average. Where if you follow this black line here, we're at 9.4% below the 5-year average. So agents will always say there's a lack of stock. Well, here's the data to prove it. We look at listing volumes per state. Yeah, again, pretty challenged in most areas. I won't skip into that one. Dwelling approvals. Yeah, so we're seeing again, this is the issue of supply. Monthly dwelling approvals fell again, and we're again not building enough houses nor enough apartments, particularly the decline in apartment building, and that's driven by very high construction costs and high financing costs. So if we could get construction costs to come down, it would make a lot more unit projects viable. Even though zoning has changed in a lot of areas, unfortunately, they're still not viable for a developer to go ahead and build them. The good news for renters is that the massive spike in rental growth has slowed. It's still significant. It's still good for landlords, but it has tapered off quite a bit, as you'd expect. So we're starting to see the vacancy rates slowly increase. They're still very, very tight right across the board, but the pace of rental growth has started to slow. But it was tracking at 9 to 10% there for quite a number of years. So good news if you're a landlord, but tough news if you're a renter. All right, let's talk a bit about migration, supply, and particularly government policy. We obviously saw during COVID massive spike in migration. We had almost 1 million people come to our shores in that sort of late 21, 22 period up to date. But as you can see by the forecasts, we're expecting to see it, leverage out. It's about 300,000 now, but it's going to sort of peter out to around 255,000 per annum. So still a significant amount of migration of people coming in to the country, and they all need a roof over their heads, Theo, somewhere to live.
Mm.
We've seen here, yeah, again, another chart by both Matusik and ABS, just showing the forecast volumes. So both sides of politics talk about restricting migration. The problem with restricting migration is that we need skilled migrants to fill jobs. We still have a, very healthy low unemployment rate, 4.2%. Used to be that 5% when I did my economics degree, 5% was always considered full employment. And now we've got a figure below that. So it's interesting. But if they were to turn off the tap, it would be very problematic for our economy. We'd have a
It's a good shout. I know I've spoken about it in previous podcasts, Rich, but we are basically importing the lack of workers that we have in various industries. So we're importing the skill sets that we need. So that it's not just a bunch of backpackers that come and work at pubs at Bondi and whatnot. It's qualified workers in appropriate fields.
exactly. And if we put all of that, both natural population increase and migration, into the long-term forecast for the ABS, they've got a number of series. They've got three estimates. They've got a series A, B, and C. And you can see here on this chart, we've just populated that we're projecting to, by the year 2050, to go from a population of 28 million to almost 40 million people. So that's a pretty significant. I just want that to digest and sit with everybody at the moment. That's a lot of extra bodies in Australia,
I,
right?
I'm going to quote Domain once again, but
Yeah.
another fellow guest podcast member of ours is Nicola Powell, who's the chief of research. So I do know a lot about their data and some of their articles off the back of it. And one piece of information they released maybe a year or two ago now, for every 1% increase in population, in overall population, it equates to an 8% increase in property prices is their modeling. So
Mm,
28 to 40 million is a big difference.
mm,
So you can only do the math on the substantial outcome they'll have in
mm.
property prices.
Now, it may not get to 40, it might get to 35 million or 33 million, whatever, but it's still a significant rise in numbers. And
Well, I think one of the biggest challenges to cater toward that 40 million is housing, right? So we talk about the limited supply.
mm, mm,
We just need to get more homes out of the ground, and there's only
absolutely.
certain
Mm.
areas of Australia that actually can do so.
That's right. Yeah. I get that's a great chart of where people are moving to. But yeah, so talking about shortages, obviously we've got, Australia's is already significantly well below where we need to be. We need to be targeting 240,000 dwellings per annum, and you can see the actual completions is way below that. We need, higher density areas, but it's basically been rising building costs, labour shortages, state taxes, restrictive planning laws, as a whole bunch of NIMBYism, a whole bunch of factors is really driving the supply factor down, unfortunately. So I guess the news or the message here is that if you're an investor, it's a great time to be entering the market. So that's why I'm very bullish about the property market. And I'm going to continue to invest in the property market because I know that there's going to be a large number of properties needed in the future.
I think it's also worth highlighting that this is the national supply, and certain markets like New South Wales, that problem's even more accentuated with a very limited supply.
Exactly. And if we look at sort of where people are moving within Australia, like interstate migration, not just not overseas migration, but within Australia itself, large numbers have migrated to Queensland, and also a fair number to WA. So you've had net outflow from New South Wales, but a net inflow to both Queensland and WA, and to a smaller extent Victoria, and a net outflow out of Tasmania. So
And
that's why a lot of the Queensland markets have done exceptionally well.
and Rich, you want to call out, your beliefs as to why that is?
A couple of reasons. One, it's, I guess, perceived as more affordable, which it is in certain markets. Secondly, it's a lifestyle factor. People love, especially Brisbane, Gold Coast, Sunny Coast. Even members of my team and other friends and family have moved up there or been up there for years. They go, "Come on, Rich, when are you going to move to the Goldie?" But it's certainly a very attractive lifestyle market. And yeah, there's a whole bunch of other reasons. But any thoughts on you, Theo, why you think that is?
Yeah, I don't know if I'd use the word perceived affordability. I think it's definitely much more affordable, especially for people in Sydney, even people in Melbourne. Ever since COVID, people can sort of pack up their bags and relocate, work from home potentially, or a lot of their professions can be transferable into another state. Um, So, for the same price as a three-bedroom unit in sort of core areas of Sydney around the CBD, you could buy a three-bedroom, four-bedroom house close to Brisbane, right? So for young families or couples soon to have families, it's a much more affordable and appealing place to live because they
Well,
can.
to your point there, I mean, if you've got a property in Sydney worth 2.5 million, you sell that, you can buy a really nice house in Brisbane for 1 to 1.5 million, and you got $1 million change.
Yeah,
That's
and you're not really buying much close to the city for 2.5 million in Sydney.
exactly. And the
It's
other point I'd make too, Theo, is wages. Like now with COVID, which has normalised wages across the board, it used to be you'd have to take a pay cut when you went to Queensland. Now you
Mm.
basically have jobs and wages more equalised. You're not taking a 20% pay cut, which is what happened with a lot of companies.
Yeah, and I think Rich, you were one of the first people that brought my attention to Brisbane many years ago.
Mm.
And Brisbane had the highest amount of population growth out of any city in Australia for the last 10 years, and the
Mm.
forecasts are for it to continue to do so. The
Yep.
fundamentals are still there. It's going through what Melbourne went through sort of a decade or two ago, where you're seeing big corporates, ASX listed companies move their head offices there because it's cheaper rent and cheaper average wages. So the CBD itself is thriving.
Mm.
So
Mm.
there's lots of fundamentals supporting long
And
term.
and that's where people sort of can get it wrong. I often get quoted, "Oh, Brisbane's had its run. It's no petrol in the tank." That's completely a wrong assumption. You've got, it's not just the Olympics coming in 2032, but it's all those fundamental drivers. It's a really attractive city. Gold Coast, Sunny Coast, they've both got very proactive councils that are more pro-development and doing up local foreshore areas and housing estates. So it's a really and Brisbane's a really nicely planned city. I really enjoy visiting when I'm up there. Mm.
Yeah, and not to harp on too much about it, but I think one more point, I was quite shocked. The amount of supply in Gold Coast, like we saw, I remember 5 years ago, or even today, you drive down the roads and the blocks of the Gold Coast, and on each second block, there's pretty much a new development coming out of the ground. And I thought, with this huge amount of supply, surely there's no price growth. But regardless of that supply of units in the Gold Coast, there's been continuous price growth.
Absolutely.
And
Yeah.
some even like the Meriton development right in the middle of Cavill Avenue there, pretty much, it
Mm.
had price growth in the settlement period. So it's amazing
Incredible.
what's yeah.
No, really good point. Thanks for bringing that up. That's excellent. All right, Theo, over to you. Tell me about the power of leverage here. I want to get your view on share market. We get asked this question: should I put my money in the share market or the property market? What should I do, Theo? Yeah.
Yeah, so this is a common consideration and I guess a discussion that we have on our podcast and webinars like this, where we compare asset classes of this is mainly aimed at people's superannuation because generally people's superannuation is invested in the ASX 200 type managed fund. In fact, this annual growth rate that's here for the ASX 200, that's the annual growth inclusive of distributions. Now, if you are in a super fund that's mainly invested in ASX top 200 companies, it would be less than this as a total growth rate because it would be less the fund manager's fees. Um, so we try and compare, all right, let's say you've got 200 to 300 grand in superannuation. Well, in this situation, let's use the number 250 to be exact. And then you compare that to buying an investment property at an 80% LVR. So all those sort of case studies there or examples there are at $1 million because you'd probably put a $200,000 deposit down and the $50,000 will be your stamp duty and other costs. Probably a decent buffer there as well. And if you look at the compounding effect of leverage, because you wouldn't leverage a superannuation fund at an 80% LVR, that's for sure. You might get a indexed ETF that has some leverage in it, but it's nowhere near to the same level. And if we exclude, so all that average growth rate, like I said, the ASX 200 is inclusive of distributions. However, all those historical, they're the 10-year averages at all the growth rates in those marketplaces in either housing or units in those marketplaces. That's the average growth rate excluding yield, excluding the rental yield, because we're assuming that the rental yield will cover the interest at 80% LVR, so break even, let's say. I've got an example on the next coming slides where we can model either a positively geared or negatively geared asset just by playing with the LVR and purchase price. But if we just look at the growth and leave out the yield, the compounding effect of leverage on your $250,000 is chalk and cheese to just investing in shares. So if we look at the 10-year growth and if we just compare Sydney, since it's right next to each other, your 250 grand in 10 years would turn into, call it double thereabouts, 500, 497. Whereas in Sydney, it's 1.8 million. Now, if we go right out to 20 and 30 years, you're talking 1 million from the 250 grand in shares, or 3.6 million in that house prices in the house price in Sydney, or 30 years, 2.2 to 7.1. That
That's
is a
massive. Like that's just compound interest off its head. It's incredible, isn't it?
Yeah. Now,
Mm,
this is actually conservative in the sense that by that 10-year forecast,
mm,
you would have some aggressive amortization on the loan. So you would have paid down a significant amount of the principal by 10 years. And
mm,
so you'd start to be quite positively geared. Now, this calculation is not factoring in any positively geared cash flows. So the ASX 200 comparison is factoring in the dividends that you get paid.
mm,
These are not. So
mm.
these are actually not showing the actual true figure in its complete
And it also probably hasn't factored in rental growth, which you can then use to pay down your loan faster either, right? Mm.
spot on, right? The next one, if we actually go on, does factor in rental growth and gearing. So
Should we go to the next slide?
yeah,
Yeah.
why don't we go to the next one? We
Okay.
won't, we don't need to break down every aspect there. So we've used two different examples here. If you're an investor looking for a positively geared asset, or you're an investor looking for a negatively geared asset, these are two sort of case studies. Now, I should preface that there is no right or wrong answer to which is best for you. It's completely driven by your personal circumstances. So if you've got a high income above the top tax bracket, which I think now is 190, then you should be chasing negative gearing because you're getting a healthy 48% sort of deduction on your income. If you're around, so if you see here, we're using an income here of about 120 to 180, then there's an argument that a positively geared asset might be more suitable, where you're actually, getting some extra cash flow on a weekly or monthly basis, as opposed to foregoing some cash flow on a weekly or monthly basis. So let's use the negatively geared house as an example. So we went Sydney houses because um, the actually it wasn't in that previous slide. It was a good one to probably highlight. But some of the assets that are growing more aggressively in capital growth typically are lower yielding, and that is the Sydney house, for example, versus the Brisbane unit. The Brisbane unit might not have had as much growth as the Sydney house, but you can see here the rental yields. 3% is the Sydney house. That's the 10-year historical, and 5% is the Brisbane unit as a rental yield. We normally have a growth rate down there. No, it's not in here, but there was a growth rate
Do you want me to
applied.
go back? I can just go back one slide for you just to show
It's
you.
actually not. I left off that one that breaks down the growth rates
Got
and
it.
the
Okay.
yields
But
because
if you go to the Brisbane unit, you can still see, well, you've even done it at 4% growth over
well,
10
no,
years.
yeah, that's just the capital growth. If
That's
we
right. Yeah.
if we go back to this is the yields is
The yield,
5%.
correct. Yeah.
Right? So 5% yield on the unit versus 3% yield on the Sydney house,
Mm,
right? So if we break it down, let's just go through, I guess, line by line on the Sydney house. Like I said, 250 to buy $1 million property. That's an 80% LVR with quite a healthy buffer for stamp duty and whatnot. Your net loss is 14,000 a year, but we used an average depreciation from BMT. So this is average depreciation for investment properties at this price range. So depreciation is not an actual cash flow loss. You can just add it back and it increases your deduction. So the potential rebate for someone buying this house with these figures, potential tax rebate on an income between 120 to 180 a year is between 10 to 13,500, call it, right? So what your actual cash loss is that 14,000, right? So that's the actual expense on your cash flow. But the actual deduction, once you factor in depreciation, is more like 30,000. That gives you that 10 to 13,000 rebate.
mm,
So if you go down to the last section there, the actual cash flow expense after the depreciation is about that 14 to 12,000, which factors in the tax rebate from the ATO. Now, also I've highlighted there, which wasn't in the previous calculations, like I mentioned, the amortization. So in these calcs, you're actually reducing the principal by about 11,500 a year as well.
mm.
So let's say that negative gearing isn't for you. You don't want to forego $1,000 a month thereabouts. All you do is look at a Brisbane unit or a different asset class with a higher yield and just structure your purchase at a lower LVR. So you can still use your $250,000, but just buy something that's a little bit less. So in this situation, we're saying a $750,000 unit that achieves a 70% LVR using a $525,000 loan. The yield on the unit, like we've highlighted, is much stronger. It's almost twice as much as the Sydney house. And if you break down all the numbers, you get, we don't need to go through each item like we did on the previous, but if you get to the very bottom one to see how we calculated it, you're getting a extra cash flow of 2 to 3,000 after a $4,000 to $5,000 rebate as well. And that's that P&I reduction there. The principal reduction there is 7,500 a year as well.
So your next slide, do you want me to go to the next one, Theo? Because you
Yeah,
showed
let's
10
go.
years down the track.
Yeah, let's look at this at 10 years down the track. So this is where we factor in the amortization to Rich's point. So total investment from 250 in 10 years, assuming that 7% historical growth rate on Sydney houses, that property should be worth 1.8. The debt should have reduced to 650,000 with that amortization. The rental growth rate, to Rich's point, was 4% per annum in Sydney houses. So the growth, the rent should now be more like 44,000. The interest rate we're using an average historical of 5%, which is actually above the. Sorry, we're using a 10% forecast, a 10-year forecast of 5%, which is above the historical interest rate. I think the 10-year average was more like 4.5. We've also factored in an assumption of increase in expenses of 2.5% and decreasing depreciation at the end of the 10 years should be about 5,500 thereabouts. So if we go to the very bottom there, the accrued equity from your $250,000 has been worth 1.18, so almost sort of 4.5 times return in 10 years. The net cash flow is, call it 8,000 to 9,000. So you're getting about a 17% ROI, 17% return on your investment per annum, call it 16.9 to be exact, in the Sydney house. And if we go to the Brisbane unit without breaking all those numbers down, what you can see, we've put those historical assumptions in. So a 4% growth on property prices, a 4% growth on the rental yield. Same thing for interest rate and expenses. The ROI is less, but you've got a stronger net cash flow, you can see. So the ROI isn't a significant amount less. It's 14.8, but bear in mind that is compounding per annum. But you can see the cash flow is much stronger because your LVR is now 30%. The loan's 427,000, so you're getting sort of 30,000 a year on that investment. Your 250,000 is still accrued significant equity, just under 4 times, you could say. So that 996,000 is what that 250,000 is worth once you take out the debt.
But there are some really good points there. And I think a couple of things to mention to the audience is that there's not a one size fits all when it comes to a particular property type or strategy. So it's going to depend on your income, what stage of life you're at, what you've got ahead of you the next couple of years. So for example, let's say, you've got a partner who's about to have a baby and you're going to go into a time where cash flow is going to be really tight for you. Trying to negatively gear another 3 properties is probably not the best idea.
No,
But
exactly
you can
right.
still invest in property and get a great return. Like buying a Brisbane unit is not necessarily a bad investment.
And that's the thing, both these outcomes will suit anyone, right? $250,000 turning into either 4 or 4.5 times return is appealing to anyone at any income tax bracket, right? So
Exactly.
it's just about making something that's going to be viable for you through
Mm.
that 10-year journey.
No, that's good. Excellent. Um, we've got a bunch more slides. I probably should have put this a bit further, but this is just going back to the inflation targets again, just looking at where inflation is likely to hit, but we know
Yeah, I
inflation's in
already
that.
touched on that one.
Yeah, I think we can skip that one. Do you want to talk about US, Australian, about exchange rates, about any
I,
points there? Mm.
I think it's just important to highlight that the Australian dollar versus the US dollar is a fundamental factor that the RBA takes into consideration for interest rate movements. And just going back to my point about the bonds market, that's the number one reason why. So if our interest rates, the disparity between the RBA and the US Fed, like I mentioned, if it's too significant, then let's say that we start dropping aggressively before the US does,
Mm,
and the disparity is in the US favor, meaning the US rates are much higher, then we'll see what's happened recently. So that's been the position the last few years. All of a sudden, all the bonds get sold off in Australia to buy US bonds, and our dollar crashes, which is what's happened recently. And that has its own inflationary consequences. So it means imports become more expensive. Sometimes some people argue that it can be favorable for our exports as they become cheaper for
mm,
things like our raw materials. But then again, those companies, all our miners, are getting lower profits if our dollar's weaker and
mm,
whatnot. So
mm,
there's a few fundamental, issues that a weak dollar has on our economy, or then again a dollar rising in the opposite direction. So we just got to keep our dollar at a sort of healthy level that makes sure that inflation, our imports and exports don't get out of
mm.
whack.
The only point I'll just make about this chart is in terms of our trade with the US, around about 5% of Australian exports go to the US. So they're not our major trading partner. Our major trading partner is China. And obviously what's happening between the US and China is going to have an impact potentially on us. But so we are obviously our trade delegation is obviously looking for other avenues to try and get around the tariffs. But the bottom line is if all of this is inflationary, property is a great safe haven against inflation. So
Yeah.
despite what you hear going on in the market and thinking, oh gosh, maybe I shouldn't invest, maybe I should do nothing, that's probably the worst thing you could do is to stay out of the property market. Mm,
I should actually probably highlight and preface that when I say our if our if our bonds get sold off in the bond markets because of our lower interest rates, it's not just against the US dollar that we're monitoring that against. Our dollar crashes in the global currency markets, right? So which then just weakens our trade position.
mm, yep. Theo, let's go to a bit of a technical question here. Debt recycling. What's all this about and how does it work?
Yeah, it's the buzzwords. I feel like of the last sort of 5 years or so. I feel like with all the TikTok influencers and all the sort of mortgage broker influencers out there, a lot of people are talking about debt recycling. Even a lot of buyers agents in your world, Rich. And it is a consideration that people should have. It is definitely something that you should put at the forefront of your decision making, just for investing in general. It doesn't need to be for property investing per se. But I guess the most simple way to introduce it as such is by saying, the goal from debt recycling is to reduce your non-deductible debt and increase your deductible debt. So on a home loan against your primary residence, that's naturally a non-deductible debt, meaning that you have to pay the interest expense with net after-tax money. And on an investment property or portfolio, that debt is deductible, meaning you can claim the interest, which effectively, if you're in the top income tax bracket, means you're halving the expense of that interest. Now, some people can achieve debt recycling, which is um, turning your owner-occupied debt into investment debt in various ways, and you don't necessarily just need to be buying investment properties to do so. So the easiest way to debt recycle your home loan and make your home loan against your home deductible is by investing in general and using the redraw in your home loan for investment purposes. So what I mean by that, let's say you've got a $2 million property with a $1 million loan, and you've got $200,000 in the offset account, because typically people these days are using offset accounts rather than the redraw. For those that don't know what the redraw is the available funds you can redraw out of the loan, out of the home loan, the actual loan account itself. And to do that, you need to have transferred surplus funds above and beyond the scheduled P&I repayments, right? So if you put $100,000 into that $1 million loan that I gave, for example, then you should have $100,000 in the redraw available to access. Now, if you redraw that out for investment purposes, you can then expense, let's say, $100,000 on that $1 million loan. So you can't achieve the same outcome by using the offset in the same way. So on that $2 million loan, on that $2 million property with a $1 million loan, if you had $100,000 in the offset and then you use that for investment purposes, technically you can't claim the interest, although some creative accountants may get around that for you. But technically you need to put the $100,000 into the loan account and then pull it out for any investment purposes. Now, I want to highlight what I mean by investment purposes. That could be buying a business, buying shares, buying property. Doesn't include buying cryptocurrency because it's got to be a yielding asset. It needs to be returning you an income. So another thing to think about with property as well, if you buy a development and in that, or you buy a property to build and develop, so for example, a house and land package, you can't claim the loan as deductible until you start earning a rental income. So for that period of construction, it's a non-deductible expense.
Fantastic.
You just need to declare the income. The income needs to be declared in that financial year. So
I
that's a
think
very
that
common way of recycling your home loan. It makes obviously a net cash flow. If you think about the compounding effect that has on your net cash flow position, you're halving your interest expense for those top tax bracket income earners. Even in that 120 to 150 income bracket, you're still getting a 35% deduction thereabouts on your interest expense. So it's something that people don't think about until after the fact. So what I mean by that, you can't apply this retrospectively. Once you go buy a property, you can't say, oh, hang on a minute. No, I meant to take that $150,000 out of my redraw. You need to make these decisions and get the right advice to implement these things at the point of transaction.
I
So
think to your point, Theo, I mean, I've done this exact strategy for 25 years where my own home has gone up in value and I've used that as the bedrock to building my wealth and a substantial portfolio. But I've always had a finance broker helping me get the right structure and an accountant to make sure everything I'm doing qualifies for the deductions that you need. So I think we've got a few more slides to get through, so I'm going to sort of just keep moving, Theo, but that's a really good
yeah,
point you made there. Yeah. Let's have a quick look at the first home buyer scheme, which was announced by the Labor government in the last elections, which they're going to implement, I believe, and legislate that to start on the 1st of January next year. Just very briefly, instead of having a 20% deposit, you'll only need a 5% deposit. There's only 35,000 places available. So essentially, you would normally have to pay LMI, Lenders Mortgage Insurance, but the government will guarantee the extra 15%. They won't give you the 15%, but they'll pay the insurance premium that is charged by the lender to cover that 15%. So instead of having to come up with a 20%, you only need 5. And there are, as you see there are limits on the amount of the property. So it's up to 900,000 for New South Wales, 800,000 property price for Victoria, etc. So that's a good little bonus for first home buyers. Let's keep moving on. Let's talk about how to turn 150K into a $5 million property portfolio. I'd love to say hands up, but if no one can see, I can't see everybody. Maybe I'm sure every hand would be going up on the webinar. How do we do this, Theo? What do we do?
So this table is a little bit confusing, and I was trying to quickly sub it out for one that we were working on, but didn't get it done in time. But this is essentially breaking down how using your $150,000, which could be in accrued equity in your home or savings or superannuation, although there's some slight disclaimers with the superannuation strategy because you can't use equity. You can basically turn that into $5 million just purely from the increased value over time in these properties and using that increased value to purchase your next one. So let's use the 150,000 on the 700,000 property as an example for property one. You can see there. So that's 150,000 as a 700 purchase is roughly an 85% LVR. So you can get some lenders that will waive mortgage insurance for an 85% LVR. That property, the forecast of that $700,000 property in 10 years will be 1.37 million, as you can see on the end. That's the part that's a little bit confusing here. But after 4 years, you should be able to buy property number 2 using that equity along the way. So the one I wanted to put in here was what that property was worth after 4 years. So call it about 950 to $1 million right there and just under halfway of that growth. And that's when you can pull out another sort of 150,000 deposit to buy your second $700,000 property. And then again, every 2 years after that, you can buy another property, meaning that after the 10 years, you'll have a total of 6 properties that are worth $5.56 million, which should hopefully then at that point be quite a rewarding stage to get to. Now, I think it's also worth highlighting. People are going to say, well, great, you're going to have all this debt on $5.6 million in property. At that stage, you can just reposition your portfolio. Let's say you're approaching retirement and this portfolio is quite geared because you have been gearing for growth. And the goal of this strategy is that you have $5.6 million worth of properties in potentially 6 different marketplaces as well. So you're diversified in terms of exposure to growth. And if the property market is appreciating by 5 to 10% a year, just call it, then you're getting $250,000 to $500,000 in growth per annum on your portfolio. This would probably be a break even or potentially negatively geared portfolio because you've been aggressively using equity to accumulate. However, let's say in 10 years you're approaching retirement and you might want to start winding down at work. You just sell a property or two to pay down the debt, and you can get yourself into a healthily cash flow positive position.
Really good. We did talk about this on one of our previous podcasts, where we talked about rebalancing the portfolio. So again, there's not a one size fits all, but I love the principle here of you get into a good growth property, and you can't necessarily buy a property next year, but you've got to be patient as an investor. But make sure you buy a good growth property that you can harvest the equity from to then leverage you into the next one to the next one. And as you say, after 10 or even 15 years, and you are wanting to rebalance, you might end up selling an asset or two, or potentially buying more high yield properties, like potentially commercial properties or even rooming houses or things with duplexes with a high yield, which we can find as well. So there's a number of different ways to skin a cat. Conscious of time, let's keep padding on. We've got a few more slides, a lot of value to give, guys. So stay with us, and then we're going to get to your questions. Let's talk about briefly self-managed super fund investments. Great idea to invest into your self-managed super fund with property. Tell us the benefits, I guess, a couple of quick points there, Theo.
Yeah, well, this is just highlighting that there's been a record amount of SMSF sort of creations or establishments, I should say. So with the lack of performance in traditional super funds in the last 10 years, so when I mean lack of performance, I think 80% of all traditional super funds haven't even met the ASX index as a benchmark. So to my point, that 7.9% that we spoke about earlier, 80% of fund managers locally in Australia don't even meet that as performance in Australian equities. So a lot of people are saying, hey, I can do better. I'm going to set up my own SMSF and buy property and maybe invest in other markets like the US. We'll keep going, Rich.
Yep, sure. Next one. All right, here we go.
Now, the reasons why it's so appealing to invest in property in particular in your self-managed super fund, I already called out previously the power of leverage. So if you just leave your money in a managed fund, you've got no access to leverage. And leverage long term in the super is fine. Leverage short term with things like equities is not good because you need to be able to ride out a storm in a downturn in equities. But in property, we'll talk about the overall tax benefits firstly. So whether it's equities or property, you're just paying a flat 15% income tax. On capital gains, whether that be shares you buy in your super or a property that you purchase and sell before retirement. So the retirement age now is 67 years old. So to Rich's point, if you rebalance your portfolio, which you might want to do to get a different yielding asset, or maybe one of the properties needs a renovation that you're not willing to do, you just pay 10% capital gains tax as opposed to the 24% you would normally pay personally. Contributions are tax deductible. Now, this sounds like an obvious one. Everyone thinks, concessional contributions being now $30,000 each. So you and a partner could put $60,000 of deductible contributions to your super. That's an obvious one. But if the property is negatively geared, or sorry, even if it's positively geared, I should say, what's appealing is that the contributions that you're using to pay down the debt are still deductions. So you can really actually build a positively geared asset that's net position and net cash flow is quite attractive while still accessing deductible contributions. So it's like a negatively geared asset, but it's truly positively geared, if that makes sense. This is an important one. The next point, SMSF debt is excluded from your personal servicing. So what I mean by that, the loan you take on a property to buy the loan you take to purchase a property in your self-managed super fund, it will never limit your personal serviceability or your personal borrowing power. So something that we see is that some people get carried away with buying investments in their personal name. They don't use trusts and whatnot, and then they're limited to upsize their home, meaning that the debt is affecting their personal servicing, and they can't, borrow more to buy renovate their home or buy a new home. The good thing about buying your super, that debt it's an arm's length, it's a completely separate entity, and there's no personal guarantee, so that debt is excluded from your serviceability. Now, lastly, the big one, after the age of 67 years old, or if you do qualify for early access, sort of into your pension mode, there is no income tax whatsoever on the rental yield, and there is no capital gain tax whatsoever on the capital gain once you sell the property. QR code for people that want to download our SMSF guide. Lots more in there about all these points in detail. We'll carry on, Rich.
It's a good one. Yep. Jeff, do you want to briefly just 30 seconds on this, and then I've got to get to the where to buy slide.
Yeah, so for some of our investors that are looking at diversifying, so once you've got, one, two, maybe even three residential properties under your belt, investment properties, some people like to look for diversification, and they start looking at commercial properties. We have now started a syndication business as a joint venture with Wingate, where we syndicate large commercial assets between $50 to $100 million. We just syndicated something late last year before Christmas, being a shopping center in the Gold Coast that had a 7.8% net yield. You can download that guide to see that asset, and if you would like to register your interest on the next one, please feel free to do so on that QR code.
Cool. All right. I'm just going to jump because we're running out of time and I want to get to the questions. Quick comment about market timing and psychology. A lot of people kind of talk to me and go, Rich, when should we buy? Like, should we just wait till the conditions are perfect and then jump in and set sail? Well, again, it's being in the market is a critical point. I mean, I created these forecasts at the beginning of the year off the back of some other forecasts. I might be a little bit conservative on these numbers now that we're getting into a big rate cut cycle, because I put these numbers together in January, February. But this is where I see the market going for 12 months. But again, don't pick a particular location on this slide just because you're looking at 12 months. You've got to be looking at a 10-year horizon and work out which capital city, what rate of growth, what kind of yield you're going to get. That's going to be the important factor. So if I go to my next slide, where similar to Theo, I've projected out the value of housing. This is just for houses. My next slide is units. Taking the last 25 years worth of data, you'll see that the annual increase in Sydney for a house has been 7.3% per annum. For Melbourne, it's been 7.4, for Brisbane, 7.5, etc. And you can see there, taking the median price from CoreLogic at the beginning of this year to where it's going to be in 20 years' time is unbelievable. Like, you go, Rich, those figures are fanciful. They're like monopoly money. Well, the reality is it'll probably happen. So again, take a long-term perspective to each capital city before you jump in. And secondly, I've also done it for units as well. You'll see there the estimated annual increases for units is about 2% lower than the housing number. So Sydney's 5.3% for a unit, Melbourne 6, Brisbane 5.4. And again, this is not just looking at 1 year's worth of data, but 25 years worth of data. So the question of whether to buy now or wait, I'm always of the opinion, buy when you can afford to buy. And no matter whether the market's up, down, or sideways, there's still opportunities to buy in the market. Final slide before we go to Q&A, where to buy. This is a whole topic for another discussion, but there's my quick snapshot. You're better off to have an individual discussion with one of my team or our director of strategic planning to work out where to buy. But there's a couple of good points. So, Theo, I'm going to close it off there and go to questions, because we've got a lot of great questions coming through. Oh, if you did want to get in touch with us, my details will be on this slide. And Theo's, you want to take a photo of that? And I've got Theo's on the next slide coming. I'm going to put our mug shots up there in a second. But do please reach out if you've got questions, and we'd certainly love to chat with you further. So I'm going to stop the slideshow and then go to the Q&A box, because there's some great questions here. Someone's asking, how will Brisbane be positively affected by Labor's 5% first home buyer deposit scheme below the $1 million purchase price? I'll answer that one, Theo. I think essentially the lower price point, any of the properties under those caps that qualify for that first home buyer scheme would see increase in demand. It's going to be that simple. It's a demand measure, and will just simply increase demand for it. So very positive for that for those sort of markets, not just in Brisbane, but all locations. Question: why are the majority of buyers agents avoiding Darwin? What's your view about Darwin for investment property purchases? Yeah, great question. I'll answer this and get your thoughts there in a sec. Look, Darwin, I'm not a big fan of Darwin because it's got a very transitory population. It doesn't have, it's got a couple of key drivers, a lot of defence personnel, a lot of essential services, but its critical population growth is not nearly the same as the major capitals on the East Coast, Sydney, Melbourne, Brisbane, or Adelaide, or Perth. So for that reason, I think there's better alternatives. Theo, what would you say? Mm,
Yeah, I'd probably just echo that same point. The fundamentals of growth aren't there, and namely, well, mainly the population growth is the key there,
mm.
and that's just because it's not a city that's got the same economic benefits like other cities.
Yeah, it doesn't have the same economic growth. It's also asking yields on houses are falling in capital city markets. Well, they're not actually, yeah, they are falling in terms of price to rent ratio, but rents have gone up. Actually, funny you mentioned Melbourne. We're actually seeing some yields increase in Melbourne. So you can't just assume that all housing yields are declining. So it's very specific to individual suburbs. He's asking, would you recommend buying townhouses or units in capital cities? We've kind of covered that. My view is you are better off, as you've seen with my figures, to buy a house if you can afford it. If you can't afford negative gearing and you do need to get more cash flow into your pocket, then yes, buying a townhouse and a unit definitely works as well.
I think, Rich, just on that note, I don't think there's like a right or wrong answer for that either, because it's so subjective to the two assets you're probably comparing. You can't just completely rule out apartments and prefer houses or vice versa. You've just got to at certain price points in comparison to certain markets. There's reasons to consider both.
Yeah. It's asking another good question about how is people's incomes going to keep up with property price growth? If incomes are only rising 2 to 3% a year, how are we going to keep up? And also identifying suburbs that are going to increase in value. So,
Well,
yeah, you go.
Well, we actually had much more than 2 to 3% wage growth in recent years. We've had some significant wage growth, and now we're having a decrease in household overall expenditure in terms of discretionary spending is reducing, but also mortgage payments are reducing. So I think households are going to be in a good position moving forward because they got through these turbulent times. Now, there is something I think your question might be alluding to also the ratio of household income to price, of the property prices. And yes, that is sort of drastically out of whack in the sense that 25 years ago, it was like 2 to 3 times the household income or average income was the price of a property. Now, the reason for the big change today, where today it's more like 9 to 10 times or more, the reason for the big change today is also a sign of the times that in each household, there's normally now two significant incomes. So 25, 30 years ago, most households were supported by one income. That's not the case anymore. The government are making lots of incentives to put kids in childcare ASAP and for the wife to go back to work as soon as possible. And most people are doing so. So I think that ratio has its reasons to be so disproportionate to
Yep.
previous times.
The other part of the question was how do we identify suburbs? I guess that's part of our secret sauce. We use a range of different data sources from many different platforms to identify suburbs that we believe are going to be doubling in value. And we make sure we cover those. Someone was asking on your comparison of stocks to property, Theo, how do you start with 250 in stocks but $1 million in property? Simple answer to that was you're leveraging the property at an 80% to loan to value ratio in that analysis.
And you'll never leverage your share portfolio at an 80% LVR.
No,
So
you won't be able to leverage it the same.
yeah, 250,000 is not going to go buy $1 million worth of shares. I think the most you can really get is like 2 times leverage thereabouts, maybe more.
Yeah. With worsening affordability, how do you see fringe areas performing, like Macquarie Park, Robina, or Nunda? Yeah, look, I think those fringe areas will perform quite well. All those suburbs you've mentioned there in that the question are very good. We definitely see the affordable end of the market possibly rising at a faster rate than the top end of the market, simply driven by affordability and people's ability to get funding. I think we've covered the house price ratio question. The threshold, the $3 million threshold question, what impact will that have, realized or unrealized, on property markets? Good question, Greg. Um, yeah, I don't like that policy. Particularly, I don't like the fact it's not indexed, and I don't like the fact that they're proposing to tax unrealized gains. I think that's a ridiculous policy. I think it will have, it's causing a bit of a scare factor amongst a lot of wealthy people that have got self-managed super funds that are potentially going to sell those assets when the legislation hasn't been enacted. If I don't have that amount of money in my super fund, but if I did, I wouldn't be selling it in a hurry. I'd be basically waiting until the legislation occurred and then deciding, okay, is it worthwhile just paying that bit of extra tax, which it probably is, versus putting it into a different entity. But that's a question to work out with your accountant. But Theo,
There-
any
There's,
thoughts on that?
yeah, there's a few fundamental issues with that might I'll be surprised if it comes in play because yes, you've got the one thing that you called out rightly so, the lack of indexing, so it's not increasing with inflation is a big issue. And whilst at the moment I think it captures something like 4% of Australians, it's going to quickly hit sort of 10 to 15% in not so distant future. The other thing is so the mechanics of how it's calculated. It's the gains as at June 30. So
Hmm.
let's say you have a share portfolio that's worth $500,000 in your superannuation, just as a part of the 3 million, you've got $500,000 in shares. If come July 15th, 2 weeks later, Trump does his tariff war thing and all of a sudden your equities plummet by 20 or 30%, you owe tax on a portfolio that's not even worth that amount you're being taxed on.
Exactly.
So that is because it won't take in consideration the portfolio on an ongoing basis. It'll take in consideration the portfolio as of June 30, which might not be the case when you're actually paying your tax. So I just can't see how that is right.
No, good point. Quick question for you, Theo. What sort of taxable income would you need to service the total debt for that $5 million portfolio example you just gave?
Sorry, could
What
you
sort of
repeat?
taxable income would you need in order to service the debt on that example of the $5 million portfolio that you gave before?
Oh, that's a very hard question to answer because it's so subjective to everybody's individual circumstances. The best rule of thumb to think when borrowing money is that you can borrow roughly 6 times your income, but bear in mind any unhealthy debt, I call it unhealthy, being unsecured debts like car leases, credit cards, things like that, even Afterpay has an adverse effect on your serviceability. On that portfolio example that I gave, all the rental incomes, even the forecasted rental incomes get factored in. Forecasted meaning when you go to buy an investment property, the bank will include the potential rental income of that asset you're purchasing. So at every time that you're going from property 2 to 3 to 4, you're getting additional income to factor into servicing. But yes, the way to maintain your serviceability, which Rich, I'm sure you've got some points to add on this. If you can afford to buy one investment property, you should be able to get approval to buy several, because if you buy it in a trust, then you can maintain your serviceability by buying the ongoing purchases in additional new trusts. So the bank will exclude, just like I mentioned about excluding the debt in a super fund, some banks will exclude the debt in your personal servicing in a trust. So that's why a lot of property experts like Rich will advise you to buy your assets in trust. It's also just a good tax structure to disperse income between different partners in the family and whatnot.
Cool. It's almost 1:45. I've got time for one more question from Martin. It says, all your cash flows don't show capital gains tax. Do you see any issues with negative gearing with the current government? But do you want to
Well,
answer the cash flow question?
yeah, so we haven't triggered any, we haven't crystallized any gain, so that you can only pay the capital gain at the end when you start selling things. So you're right, we didn't factor in any capital gains because you would not have paid any in all those situations until you actually decide to sell something. So it's can't recognize that yet. What was the second question
The
again?
second part is, do you see any issues with negative gearing? I'll answer that one. I would say no. Both sides of politics, particularly, I was happy to see Albanese say in his debate before the election, saying they won't touch negative gearing because the experts have told them it would exacerbate housing supply issues. So I don't believe they're going to touch it. They may play around with depreciation rates or something at a future date, but I believe negative gearing is here to stay. They'd have to remove it on shares and other types of assets, and I think it's a legitimate way to encourage private investors to help fund property investing.
I have to echo that one. It was a bipartisan issue, which was good to see that both have ruled it out. And I think um, there was a comment from Albanese that he's finally recognised that the experts are saying it won't be a good solution to housing. If you think about the best way to think about negative gearing and what it could potentially do to housing, how does increasing the taxes on housing decrease the price? We've already got a fundamental issue that developers pay almost near half the overall cost of building a unit goes to various taxes and levies. So making it even more expensive by increasing the taxes isn't going to solve the housing crisis, is the conclusion that both parties have recognised.
Awesome. I'm very sorry, folks. We're going to run out of time, but I know there's a few more great questions there. But if you do have questions or like to reach out, can I just encourage you to reach out to Theo and myself and our companies? We've got plenty of folks that'll be happy to chat with you. But I want to say, Theo, thank you for your knowledge and sharing your wisdom today. Been great to have you on the webinar.
Thank you, Rich. Been great to do this with you.
Yeah, great. And look, please reach out, as I say. Wish you all the best, and we look forward to seeing you again on another Property Buyer and Sure Financial webinar. Bye for now.
Bye for now.